Good morning, I'm Sasmitha, metric number EX03688. Today I'm going to present about what is the merge and acquisition of accounting. Okay, what is the merge and acquisition accounting? It means mergers and acquisition is a general term used to describe the consolidation of companies or assets through various types of financial transactions, including mergers, acquisitions, consolidations, tender offers, purchase of assets, and management acquisitions. The term M&A, which is merge and acquisition, also refers to the desk at financial institutions that deal in such activity. This is the essence of merger. The terms mergers and acquisitions are often used interchangeably, although in actuality they hold slightly different meanings. When one company takes over another entity and establishes itself as the new owner, the purchase is called an acquisition. From a legal point of view, the target company ceases to exist. The buyer absorbs the business and the buyer's stocks continue to be traded, while the target company's stock ceases to trade. On the other hand, a merger describes two firms of approximately the same size who joins forces to move forward as a single new entity rather than remain separately owned and operated. The action is known as a merger of equals. Both companies' stocks are surrendered and new company stock is issued in its place. Point. Both diamer bands and parallel case to exist when the two firms merged and a new company, Daimler Crystal, was created. A purchase deal will also be called a merger when both COE agree that joining together is the best interest of both of their companies. And here the action of acquisition. Unfriendly deals where target companies do not wish to be purchased are always regarded as acquisitions. Therefore, a purchasing deal is classified as a merger or an acquisition based on whether the purchase is friendly or hostile and how it is announced. In other words, the difference lies in the deal is communicated to the target company's board of directors, employees, and shareholders. Nestle Instead performed a variety of acquisitions lately. These are the type of mergers and acquisitions. Okay, first we're going to see about the merger. In a merger, the board of directors for two companies approve the combination and seek shareholders' approval. Post-merger, the acquired company ceases to exist and part of the acquiring company. For example, in 2007, a merger deal occurred between Digital Computers and Compaq, whereby Compaq absorbed Digital Computers. And acquisitions, which mean in a simple way, the acquiring company obtains the majority stake in the acquired firm, which does not change its name or alter its legal structure. An example of this transaction is a Manulife Financial Corporation 2004 acquisition of John Hancock Financial Service, where both companies preserve their name and also their organizational structure. And consolidational means create a new company. Stockholders of both companies must approve the consolidation. Subsequent to the approval, they receive common equity shares in the new firm. For example, in 1998, Citicorp and Travelers Insurance Group announced a consolidation which resulted in Citigroup. Tender offer. In a tender offer, one company offered to purchase the outstanding stock of the other firm at a specific price. The company the offer directly to the other company shareholders, bypassing the management and the board of directors. For example, in 2008, Johnson & Johnson made a tender offer to acquire Omic Biopharmaceutical for $438 million. While the acquiring company may continue to exist, especially if there are certain dissenting shareholders, most tender offer result in mergers. An accusation of asset. In an accusation of asset, one company acquires the asset of another company. The company whose assets are being acquired must obtain approval from its shareholder. The purchase of asset is typical during bankruptcy proceedings where other companies bid for various assets of the bankrupt company, which is liquidated upon the final transfer of assets to the acquiring firm. Management accusation. In a management accusation, also known as a management lead buyout, a company's executive purchase a controlling stake in another company, making it a private. This former executive often partner with financial or former corporate officers in an effort to help fund a transaction. Such M&A transactions are typically disproportionately with debt, and the majority of shareholders must approve it. For example, in 2013, Dell Corporation announced that it was acquired by its chief executive manager, Michael Dell. Okay. Mergers may be structured in multiple different ways based on the relationship between the two companies involved in the deal. Horizontal merger, two companies that are in direct competition and share the same products and market. Vertical merger, a customer and company, or a supplier and a company. Think of a cone supplier merging with an ice cream maker. Congeneric mergers, it means two businesses that serve the same consumer based in different ways, such as a TV manufacturer and cable company. Market extension merger, two companies that sell the same product in different markets. And product extension, two companies selling different but related products in the same market. And finally, conglomeration, which means two companies that have no common business areas. Mergers may also be distinguished by following two financial methods, each with its own ramifications for investors. First is purchase mergers. As the name suggests, this kind of merger occurs when one company purchases another company. The purchase is made with a cash or through the issue of some kind of debt instrument. The sale is taxable, which attracts the company to enjoy the tax benefit. Acquired assets can be written up to the actual purchase price, and the difference between the book value and the purchase price of the asset can depreciate annually, reducing taxes payable by the acquiring company. Another one is Consolidation mergers. With the merger, a brand new company is formed and both companies are bought and combined under a new entity. The tax terms are the same as those of the purchase merger. Okay, and here are some detail of acquisitions. Like some merger deals, in acquisition, a company may buy another company with cash, stock, or a combination of the two. And in smaller deals, it is common for one company to acquire all of another company's asset. Company X buy all of company Y as for cash, which means that company Y will have only cash and debt, if any. Of course, company Y becomes merely a shell and will eventually liquidate or enter other areas of business. Another acquisition deal known as reverse merger enable a private company to become a publicity listed in a relatively short time period. Reverse mergers occur when a private company that has strong prospect and is eager to acquire financing by publicity listed shell company with no legitimate business operation and limited assets. The private company reverse merge into the public company and together they become an entirely new public corporation with tradable shares. Thank you. I hope I did my level best in explaining about the merge and acquisition accounting. Thank you.